St. Mary's College, Biz Ed 123, Homework 1, Team 1, and Action.
Okay, so for question 1.19, the major factors that affect a firm's stock prices are the characteristics of the firm, economy and stocks, environment of the business, and expected cash flows and current market conditions. And then for 1.25, information asymmetry in a business transaction is where one party has information that is not available to the other parties in the transactions, and when the party with less information understand their disadvantage, they are likely to pay lower prices for the goods and services purchased and higher for what they sell.
And then I have 8.5.
Can we just go around like we do that? Because we can't, we'll have to shift the cameras and stuff. Thank you. So you'll have to jump up there.
So this is question and problems 2.7. Just by looking at Trader Inc.'s asset value of $300 million, you can tell that they have a larger firm size. So they're more likely to go public because they can afford the costs of registration and compliance to the SEC. And then 2.15, it's just definition. So money markets are short-term debt investments with maturities less than 1 year. And then capital markets are equity securities and debt instruments with maturities over 1 year.
Alright, so the first question, 224, pretty self-explanatory. The question is, what are two risk hedging instruments? And the answer, the options contracts and futures.
And then 2.4 here, we have three forms of the efficient market hypothesis. Number one here, strong form efficiency. This means all information is reflected in the security prices. Number two is semi-strong form efficiency. All public information is reflected in the security prices. And number three would be weak form efficiency. All information contained in past prices is reflected in security prices.
Don't forget to speak up really loud because it's hard to hear from back here.
I don't know, skip this, but 3.7, it's they're looking for an income statement. So they give you the revenues. That it was $1,405,000. And basically what you need to do is that you rest the COGS that they give it to you, that's cost of goods sold, which that gets to the EBITDA. They give you the depreciation, the expenses, which is this, and you just rest each to get your total net income. And then 3.9, they're asking you for what was the net cash used in investing activity. So basically you just add what you use for the net property, equipment, and assets. There was nothing in the net acquisitions and depositions, and in the investments in marketable securities, you just add those, and that's the total net cash used.
So this is a statement of cash flows on a company that paid back a loan and increased long-term debt, and their loan repayment should be replacement. So they paid out $312,000, and then they increased their debt by $650,000, and they purchased treasury stock to get $670. And this is an expense, this is an add of cash, and this is an expense. And then for 313, this is Hillman Corporation reporting assets, and they want the cash flow invested in net working capital at Hillman Corporation. And you have
And yeah, that's 313.
yeah, that's 313.
I couldn't find it on there.
So for 3.14, it's talking about long-term assets and seeing how much they invested into the company. And December 31st, 2013, their long-term assets were $1,211,105, and in December it was $990,560. So you take the long-term assets of 2013 and you minus it by the 2014, and that gives you the total invested in cash flows for its long-term assets. And the quick ratio is better than the current ratio solely because it takes inventory into account, and inventory is not as liquid as other things in current assets, so that's why you account for that by minusing it from current assets and then dividing by current liability.
Okay, so for question 4.4, they're asking for the inventory turnover ratio of the company, and they give us the gross product margin of 33.7%, sales of $47,112,365, inventory of $14,595,435. And then so first we solve for the GPM, which is net sales minus cost of goods sold. But we're not given cost of goods sold, so we have to solve for it here by like flipping it and then putting the GPM equal to 0.337 and doing that, plugging in numbers, which gives us our cost of goods sold of $31,235,498. And then to do the inventory turnover ratio, the equation is cost of goods sold divided by inventory. So we can plug in those numbers of cost of goods sold here divided by inventory, which gives us 2.14 times.
Here we're looking for the debt to equity ratio. So first we start with total assets, and we times that by our debt ratio, but right here we have a percentage, so we need to move that little point over 2 because it's a percentage. And then from there we have our total equity, and then from there we take our total assets minus what we just found, our total debt, and then we have our debt to equity ratio, and then from there we can find our equity multiplier, and we take our total assets over our total equity.
Oh, I'm going to.
Don't forget to speak loud. Did anybody who wants to come and see me on Sunday and Monday? 2 to 4.
Oh,
Okay, so for the first problem, the givens we have are the total asset turnover of 2.1 and the net profit margin of 7.5% and an equity multiplier of 1.9. And in order to calculate the ROE, you take the ROA times the equity multiplier. And then in order to calculate the ROA, it's net profit margin times total asset turnover. So if you calculate it, then in order to get, I think we're calculating the ROA, which is 7.5% times 2.1, which equals 15.75. So that's the ROA, and then now we're going to calculate the ROE, which is the number you just got, which is 15.75%, and then you multiply it by 1.9, and you get an ROE of 29.93%.
The
then for 4.12, we got given the net earnings, the shares outstanding, and the year-end stock price. And we're solving for the EPS, which is earnings per share, which is net earnings over shares outstanding, and that equals $2.55.
So for 4.21, it's basically just asking us to calculate three different things. So the gross profit margin, the operating profit margin, and the net profit margin. So I wrote out the equation. So for gross profit margin, it's net sales minus cost of goods sold divided by net sales. And I just worked it out. Operating profit margin is EBIT divided by net sales, and the net profit margin is net income divided by net sales. So that was basically that one. The second one asked you to use the DuPont ratio, or the DuPont equation, and it was asking how this organization managed to achieve the same level of profitability as reflected by the ROE. So we basically just calculated it for the peer group and for the organization, and found out that they did this by using a higher degree of financial leverage indicated by the equity multiplier.
It was just plugging it into the formula.
Basically.
For 5.1, we're looking for the value of the investment in 10 years. So this is the equation, and so we plugged in the amount invested today, which is $25,000, and then we multiply it plus this, which is the return expected from the investment, and then plus 1 to the 10th power, because in 10 years, and then you get $53,970.
And then for 5.7, you're trying to find the future value of a 5-year 100K investment, quarterly, monthly, daily, and continuous. So the M is the frequency of compounding change, and the last one is continuous. And then the PV is the amount of invested today, which is going to be 100K all the way through. And then the I is the return expected upon investment, which is 0.0875. And then the duration of the investment is 5 years, so you're going to multiply 5 times 4, which is quarterly, 12, which is monthly, 365, which is yearly, and then this one's just continuous. And just gives the answers.
So for 5.8, we're calculating for the future value. So the present value would be minus 15. The future value, and then so it would be future value equals PV times 1 plus G, which is the home runs, and to the power of N, which is the growth period. So it would just be 26.4 home runs.
And so for 5.1, the value of the inventory after 2 years is F, the future value, but it's $750. I equals 6.5%. 365 equals 0.065. And then 0.00018. So to find N, you take 2 years and you multiply it by the 365 days per year, and you get 730 days. And then future value sub N over 1 plus I, N equals 750 over the number from up above, and it equals $657.66.
Invest $150 in a mutual fund today that pays 9% interest annually. How long will it take the
Alright, so 6.5. 6.5 is Jeremy borrowing from his buddy. It tells you how much he's going to repay him each year. So the amounts that he's going to repay are found on the top. So, you know, 1,225, first year, second year, 1,350, etc. So you place those on top of the present value formula. On the bottom, you have that his friend charges, you know, the 8% rate for borrowing each period. So what it would be is 1 plus R, the rate of borrowing, so 1.08. And then here you would put the exponential of what time period it is. So I didn't put 1 here because, you know, it's just going to be that number. But second year, so you put 2, 1.08 to the 3, 4, 5 for the years. And then when you compute that, it turns into his total amount that he's borrowing is $5,747.4.
And we have 6.7, which is present value of an ordinary annuity. So here's the formula here, as you can see, as I'm sure you saw it. And then when we plug the numbers in, we have the annual payment at $750, the number of payments at 12, and the rate of return at 8% down here. So when we do this calculation, it comes out to 750 times 7.5361. That number comes out to $5,652.06.
So for 6.9, it says that Robert Hobbs plans to invest $25,000 a year at the end of each year for the next 7 years in an investment that will pay him a rate of return of 11.4%. How much money will Robert have at the end of the 7 years? So basically, we're just trying to find the future value. So this is the equation. It would be future value equals PMT times 1 plus I to the n minus 1 over I. And basically, you just plug in these numbers. Annual investment, 25,000. Number of payments is N, which is 7. Investment rate of return, 11.4%. You plug it into this equation, and you get 247,609.95. And then for 612, same equation. We're just trying to find the annual investment instead. So we're trying to solve for PMT. So you get future value of the annuity, 5,000. Return on investment, 10.3%, and then we're just trying to find PMT, so use the same equation and solve for PMT, which is 1506.2.
So for 6.15, you're solving for PMT as well, but instead now you are multiplying present value times interest to get PMT. And so for this one, the present value of the investment needed is 250,000 times 6% interest equals 15,000. Then 50,000 times 12% interest equals 6,000. 100,000 times 10% interest equals 10,000.
For 617, finding the effective annual interest rate, the equation for this would be 1 plus the interest rate, which is 6.75% or 0.0675, over the frequency, which is 365 days, to the power of 360, again the frequency, which is 365 times 1, so you get 365 minus 1, and you get 7% embedded into that equation.
And for 6-21, somebody won the lottery and they're being paid over 7 years, and each year the amount goes up by 50,000, and that's why there's dots there, because it's redundant. And so we just take the present value, or the future value equation, which is, and the firm is confirming that it would be approximately 10.5% returns each year. So you just plug everything in and you get this amount. And for 6.3, an NFL player's agent is negotiating a contract, and they want to find the best contract. So the current contract, using the present value or the future value equation, you get 12 million, which they wanted more. The team countered with something lower, which is kind of horrible. But they finally countered with a bigger offer of 14 million, so the counter is the best offer.
So 7.6 and 7.7 are related to each other. It's telling you the difference between the arithmetic and the geometric mean. So everyone pretty much probably knows how to do the arithmetic mean. You add up all of the values and divide it by the number of values, and you get that return. The geometric mean's a little bit more complicated. You do 1 plus the decimal version of the percentage. You multiply them together after adding them up, and then you take it to the power of 1 over the number of percentages or whatever values that you're using, and it comes out. The geometric mean is always going to be less than the arithmetic mean because it accounts for variance, unless your variance is 0, in which case they're going to be the same.
So our first one's on T-bills, and the answer is, since the beta of any asset is the slope of the line of best fit for the plot of an asset against that of the market return, then we can use that logic to help us understand that the beta of a T-bill. The meaning of a beta of 0 means that our T-bill has no systematic risk. That is logical given that we know that a T-bill has no risk at all, since it is a riskless asset.
And then for 7.18, we had to find the variance and standard deviation, and we plugged it into the equation here. We got a return of 0.08789.
Alright, for 8.3, we had a company issue a 3-year bond that pays a coupon rate of 6.1%. And so here are all of the givens that the problem gave us, and then we make the chart like we learned in last class, and plug it all into this formula. There it is plugged in, and we get 1,008.15.
For 8.8, we're looking for what the price of bond will be, but with the appropriate discount at 14%. And so this is the equation, and we plugged in the, for this one, it's $1,000. And then just plug everything in, and it's to the 20th power because, I mean, that's a huge number, right? But your total is 258.42.
And then for 8.9, we're gonna try to find what yield of maturity we can be expected to earn if the bonds have a market price of 981.13. So we're gonna basically put it all in this equation, and the ends are the years to maturity. The coupon rate is 5.875%. The semi-annual coupon is this right here, and then the yield to maturity is the I, which is what we're trying to find. So the yield to maturity of a bond is the discount rate that makes the present value of the coupon and principal payments equal to the price of the bond, and we know that the yield to maturity is higher than the coupon rate, so we interpolated it at 6.6% to get 981.
The question for 8.5 was which of the following classes of securities is likely to have the lowest corporate borrowing cost? And the answer was A, which is the AAA rated bonds. And that's because the issuers of the AAA rated bonds should have the lowest borrowing cost because their default risk premium is lower than issuers with a weaker credit rating. And then 9.2, it says, what is the Dow Jones Industrial Average? And the Dow is the most widely published stock index and reflects the value of stocks of 30 large companies. The value of the shares represents about 20% of the market value of all the U.S. stocks.
Yes, it's just.
I'm doing 9.3 and 9.5. So 9.3 is a question asking what does NASDAQ stand for and what is NASDAQ. So it is a short version of this name, National Association of Securities Dealers Automated Quotation System, and it's one of the largest stock markets in the world. And it is an OTC market and does not have any physical location. And then for 9.5, the question is saying there's like a company whose management expects it to grow at a rate of 30% over the next 2 years. So there's like a timeline. So for the first 2 years, first year and second year is 30%, and then the next following 3 years, the growth rate is going to be 18%, and then the rate of return is 14%. And also the dividend paid by the company was $2.15. So it's like a timeline. And then to calculate the present value of the dividends, I get in the first year $2.15, which is the dividend paid by company times the growth rate for the first year is 30%. And then the result is $2.795. And then you get this result as to calculate the second year, and then times the growth rate of the second year, and this is how you calculate for all 5 years. And then to calculate the present value, you just add them all, but you need to divide them by the rate of return based on the year, to the power of the year. So for example, it's the second year, that is 1.14, because rate of return is 14%, to the power of 2, and then add them together and become $14.24.
Excellent, thank you.
All right, so 9.5 is regarding Fresno Corporation. So it says, so basically I drew out this just to illustrate what is found in the problem. But so it says 30% in the first 2 years. So from G1 to G2, it's 30% right here, and then 18% in the next 3. So from G3 to G5, so 3, 4, and 5, 18%. In that, the last dividend was $2.15, that's given, as well as the rate of return required at 14%. So D0, the dividend of year 0, I guess, would be $2.15, R equals 14%. So if you plug it into the formula, the present value of the dividends formula, you would get, basically you would take this D1 value, which would be D0 times 1 plus G1. So that's D0, so that's 215 times 1 plus the 0.3, because it's 30%. And then you would place that value as right here on the top, and then the bottom would be the 1.14, because it's 1 plus the rate, which is 14%, so 1 plus 0.14 on the bottom times to the exponential of whatever year it is. So because this is the first year, it's 1 exponential. And then you basically continue to do that each year, taking, so for example, for the second year, it would be D2, which would be the D1 value that you got times 1 plus G2, and G2 is still 0.3 because 30%. You would add all of them up together, and eventually you would get the answer of 14.24.
For 9.6, it was titled Zero Growth. So we have our dividend that paid off at $4.18 there. G is 0 and the rate of return is 18.5. So when we line up the formula, your D over the R, you have your 418 over 0.185, and that'll get you to 22.59.
Okay, so for 9.14, we're trying to find the stock's current market price. So it's similar to 9.6. You're given the dividend, which is 4.5% times the $100. And then R is the required rate of return. And plug it into the equation, which is D over R, and you get $54.55.
And for 9.24, they give you this information and they're asking you for the value of the stock. So with this information, you just plug it in the equations and you get the answers.
On the exam, make sure that you calculate everything.
Yeah, I couldn't fit it.
Okay.
So for 936, Triton Inc. is expected to grow at a rate of 22% for the next 5 years, and then settle to a constant growth rate of 6%. The company recently paid a dividend of $2.35. The required rate of return is 15%. So for A, you have to find the present value of the dividends during the rapid growth period if dividends grow at the same rate as the company. So that's what all of this work is right here. And then you're going to take these numbers and put it up top. And so this would be year 1, year 2, year 3, year 4, year 5. Do all of that math, and that's the present value of the dividend after 5 years. What is the value of the stock at the end of year 5? So you'll take, 15%, growth rate of 6%, and then you put it in the equation. You get that, $74.80. That's after year 5. That's what the stock's going to be worth. And then what is the value of the stock today? So you're going to take up here the dividend after year 5, and then you're going to find the present value to today, which is 37. You're going to add those two numbers up and you get 51.20.
And then on the, because in the 5th year you got $6.351, and then for P5 you got 6.732. So remember, you have to grow it out one more year.
Yeah, one more year.
Yeah.
Yeah.
Just want to make sure
to get to year 6. Yeah.
Got it.
Yep.
To get the terminal value.
Yes, sir.
Okay. Just want to make sure that everybody
Okay.
knows you got to go one more year.
Yeah, one more year. So you're going to do the same thing, 635 times 1.22 to get to 6732.
Perfect. Thank you. Yeah, that was it. Okay. Go ahead.
Hi, I'm Sienna. I'm Jocelyn.
Sienna's got a, what are you playing?
Yeah, I play volleyball, so I'm missing class tomorrow, or Thursday to travel, so we're trying to do this today so that I don't have to make Jazz do it by herself on Thursday. But we're in charge of Chapter 9, which is stock valuation, and the learning objectives for Chapter 9 are to be able to describe the 4 types of secondary markets and to explain why financial analysts treat preferred stock as this special type of bond rather than as an equity security. And we need to be able to describe how the general dividend valuation models value a share of stock. And we need to discuss the assumptions that are necessary to make a general dividend valuation model easier to use, and use the model to compute the value of a firm's stock. We need to explain why G must be less than R in a constant growth dividend model, and explain how valuing stock with a stated maturity differs from valuing preferred stock with no maturity. The market for stocks. Stocks are equity securities, so they represent certificates of ownership in a corporation. Households hold the largest share of equity securities, more than 35% of corporate equity, so that's just people buying stocks. Pension funds are the largest institutional investors in equities, followed by mutual funds and foreign investors. So a secondary market is when investors buy and sell previously issued securities among themselves in secondary markets. They provide marketability and fair prices for shares of stock, and firms receive higher prices for securities they issue in a primary market because the investors are more willing to buy securities because they're easy to resell in a secondary market.
Secondary markets are market efficiency. In an efficient market, stock prices are updated constantly as new information reaches the market and is immediately incorporated into estimates of market values. Secondary markets bring us closer to the ideal of a perfectly efficient market. They provide information about security pricing, give buyers and sellers access to each other, make it easier to complete transactions, and low transaction costs. The New York Stock Exchange and National Association of Securities Dealers Automated Quotation rank 1 and 2 in total volume and total capitalization. The NASDAQ is larger than the New York Stock Exchange in terms of number of companies listed and shares traded daily. Most secondary market transactions in the US occur on a stock exchange. Secondary markets differ in the amount of information about prices available to investors, which influences each market's efficiency. There are 4 types of secondary markets: direct search, broker, dealer, and auction. The market for stocks. Direct search. A buyer and seller must find each other without assistance. A search among all possible partners to locate the best price is seldom done. In most common instances where direct search is used is sale of small private firms' common stock and private placement of common stock. Brokers earn a fee for bringing buyers and sellers together. A commission that is less than the cost of direct search gives an investor the incentive to pay a broker for price information. The dealer market efficiency is improved if someone provides continuous bidding for a security so no time is lost searching for a partner. Dealers provide this service by owning inventories of securities from which they buy and sell to earn profit. The dealer market eliminates time-consuming searches for a fair deal through immediate sales or purchases using a dealer's inventory of securities.
So NASDAQ, they're the best known dealer market, and electronic communications network, or also known as the ECN systems, provide price information which should increase marketability and competition and improve NASDAQ's efficiency. So dealers are important to kind of make things run more smoothly. And dealer markets are called over-the-counter or OTC markets. Auction. In an auction market, buyers and sellers interact with each other in a group and bargain over price. The auctioneer or specialist is designated by the exchange to be a dealer for certain securities and fill orders by public customers. And the NYCE is the best known auction market, and it is the most efficient equity market in the US. The auction for a security on the NYSE takes place at a specific post on the floor of the exchange. So a stock market index is a select group of stocks whose performance is used to estimate the performance of a larger group of stocks. So these are all the stocks that we've been looking at lately, and they're different stock market indexes or indices. Equity securities, there's common stock and then there's preferred stock. They represent the ownership and interest in a corporation. They are the 2 most frequently used types of equity securities, and dividend payments, they don't affect firms' taxes, and they have limited ability, so claims made against corporations cannot include stockholders' personal assets, so kind of like separate stockholders and their other stocks. But they're generally viewed as perpetuities because they do not have maturity dates, and they are not guaranteed dividends, but dividends are promised to preferred stockholders. Common stock is the most basic ownership claim on a corporation. Common stockholders have the right to vote. They get to elect the board of directors. They have capital budgeting. They can vote for capital budgeting, and they vote for proposed mergers and acquisitions. Common stockholders have the right to a firm's residual assets after creditors, preferred stockholders, and others with higher priority claims have been satisfied. Preferred stock represents the ownership in a corporation. Preferred stockholders do not have the right to vote. They have priority over common stockholders with respect to dividends and liquidation of assets, but they must be paid a fixed dividend before funds are distributed to common stockholders. So from what I understand, they kind of get paid before the common stockholders get paid. And preferred stock is equity, but a strong case can be made that is a special type of debt. Dividends are due regardless of earnings, so no matter how much the company's making, the preferred stockholders have to be paid their exact dividends. And it frequently has a credit rating, and it may be convertible or callable.
Valuation of equity securities. The value of common and preferred stock is estimated using the methodology employed for bond valuation. Although valuing common stock is more difficult than valuing bonds or preferred stock. The size and timing of dividends are less certain compared to coupon payments. The rate of return on common stock cannot be observed directly from the market. Common stock is a true perpetuity because it has no maturity date. This is a one-period model for market value. Market value of a share of stock today equals the combined present value of two future cash inflows, the expected end-of-period dividend and the expected end-of-period stock price, and that's the equation for it there. This is the two-period model for market value. The dividend valuation model. The perpetuity model for market value can be viewed as an infinite series of one-period stock pricing models. Although theoretically sound, it is not practical to add an infinite number of terms. And then that's the equation. General dividend valuation model. The value of a share of stock is the present value of all expected future cash dividends. The model requires dividend forecasts for an infinite number of periods. The model implies the intrinsic value of a share of stock is determined by the market's expectations of a firm's future cash flows. The model does not include specific assumptions such as whether the growth rate is constant, important in estimating expected future cash dividends, and how to forecast dividends or when a share of a stock might be sold.
So next we have the growth stock pricing paradox. Growth stock is the stock of a company whose earnings are growing at an above average rate and they're expected to continue to do so for a certain amount of time. And rapidly growing firms, they typically pay no dividends on common stock during the growth phase. They have a high return investment opportunities. Investors are better off if firms reinvest their earnings. But equation 9.1, that's the last one, and common sense predicts that the shares of a company that will never pay cash to investors are worthless. In reality, high growth firms will eventually pay the dividends, but if investments are made with reinvested funds, if investments made with reinvested funds succeed, a firm's net cash inflows should increase significantly and the investors can sell their stock at a much higher price than what they paid. To make equation 9.1 more applicable, some simplifying assumptions about the pattern of dividends are necessary. So the dividend has a 0 growth rate and is always the same. The dividend has a constant growth rate, and the dividend has a mixed growth rate, higher in some periods and lower in others. So here's the 0 growth dividend model. This model assumes that the dividend is constant. This cash flow pattern describes a perpetuity with a constant cash flow, similar to the perpetuity model. Here's the equation. So an example of a 0 growth dividend model is Del Mar Corporation pays a $5 dividend per year, and the board of directors has no plan to change the dividend. The firm's investors require a 20% return on investment. What is the expected market price on the stock? So in order to figure it out, you have to take the dividend, which is $5, and put it over the 20% return on investment, and then you get $25. Here is a graph.
Do you want me to do that one?
Yeah.
Okay. And this one basically says that because if you do a discounted cash flow on the dividends and you go out into the future, because the discount factor gets so big that it basically wipes out the present value of the cash flows. So the majority of the value, the present value of the stock is within the first 5 to 10 years. And I actually think it's probably around 5 to 7. And then as you go further out, actually this piece right here, I think I explained it in class. That's why you take that terminal value. That's why you grow out to the dividends to the 6th year, and then apply the perpetuity or the Gordon growth, get the terminal value, and then add it to the, in that case, the 5th year, and discount it all back. That terminal value is this piece right here. Okay, so you don't have to do it. But the majority of the value of the stock is in the initial cash flows, and it's the same thing with any investment that you make.
Constant growth dividend model. Model assumes cash dividends increase at the rate G from one period to the next forever, which is a reasonable assumption for mature companies with a history of stable growth. That's equation 9.3. Equation 9.4 is the current price of a share of stock is next period's dividend divided by the difference between the discount rate and the dividend growth rate. Computing future stock prices. The constant growth dividend model can be generalized to value a share of stock at any point in time. The relationship between R and G. The constant growth dividend model yields invalid solutions when the dividend growth rate equals or exceeds the discount rate. If G equals R, the denominator is 0 and the value of the stock is infinite, which cannot occur. If G is greater than R, the denominator is negative and the stock price is negative, which also cannot occur. The constant growth dividend model is therefore only valid when the required rate of return is larger than the expected growth rate. Supernormal dividend growth model. Some firms experience a supernormal rate of growth in dividends in the early years. If the supernormal growth occurs first and is followed by a constant dividend growth, we can combine equations 9.1 and 9.5. Valuing preferred stock. To value preferred stock, one must know if it has an effective maturity because of a sinking fund or call option. The most significant difference between preferred stock and a bond is the stock has greater risk of not receiving the promised payments. Preferred stock dividends are payments to owners of the firm, and failure to pay does not constitute default on an obligation. Failure to pay a preferred stock dividend, as promised, has significant financial consequences because it signals the market that firm has serious financial problems.
So preferred stock with a fixed maturity. Preferred stock with a fixed maturity is, priced using a bond valuation model, adding the present value of the dividend payments to the present value of the par value. Most preferred stocks make quarterly dividend payments, so M will equal 4. Here is equation 9.7, which is how to calculate preferred stock. Perpetual perpetual preferred stock. Perpetual preferred stock has no maturity dates, dividends are fixed, G will equal 0, and dividend payments go on forever. Equation 9.2, zero growth dividend model, is used to value perpetual preferred stock, and there is equation 9.2. An example of perpetual preferred stock: suppose Delta Airlines has perpetual preferred stock that pays a dividend of $5 per year. Investors required an 8% return on similar investments. Try and figure out the value of Delta's preferred. So you set up the equation, G over R, you're given the dividend, which is $5 per year, and the 8% return is below, and then you're going to get a preferred stock of $62.50. Here are some of the homework problems. We did 9.6. The question is, using zero growth, Nye Inc. paid a dividend of $4.18 last year. The company's management does not expect to increase its dividend in the foreseeable future. If the required rate of return is 18.5%, what is the current value of stock? We put up the solution, so you're given the dividend of $4.18, and because it's zero growth, the growth rate is at 0, and the return is 18.5%. You use the same formula that we just gave you, and you put $4.18 over the 18.5% return, and then you will get the value of $22.59. And there's, yeah.
Yeah, we have them up there too. Okay, great, thank you very much, that was great. Do you guys want to take pictures of these? The solution? If you want to. Yeah, it's all mine.